Hey guys, David Robinson here. Welcome to the Lead Sponsor Podcast. We've got another great episode for you today. My guest is someone that has an extensive background in the real estate business. He has served as an instructor for apartment associations. He's been on the board of directors for a multifamily housing association. He's had multiple positions for the Institute of Real Estate Management. He's grown a property management company to over 6,500 units and sold that company in 2018. Not to mention that he has owned over 6,000 units of multifamily, has recently sold about 4,000 of those units, and still holds about 2,000 units of multifamily. He is the founder and CEO of Obsidian Capital, and I'm really excited to introduce you to Glenn Gonzales.
All right, Glenn, we're so excited to have you on the show today. Thanks for spending some time with us. To get us started, you've got a pretty interesting story and background and how you eventually have gotten to where you're at today, which is having acquired over 4,500 units of multifamily during your investing career, and the founder and CEO of Obsidian Capital. But there's a whole backstory. So let's spend just a few minutes and let's talk about, what the world looked like for you before you got to where you're at today.
Yeah, thanks, David. And thanks for having me on your show. I understand it's quite the successful podcast. So I'm honored to be a part of your show. So thank you for putting me on your list. I'm honored. Yeah, I started off in the industry, actually there in Salt Lake City, Utah, years and years ago. I'm old now, so I'm not going to tell you kind of when that was. But I was going to school up at the University of Utah, and I was working as a waiter. And my wife at the time called and said, "Hey, our apartments where we live need a maintenance guy. Do you want to come do some part-time maintenance?" And I'm like, "Yeah, because this, waiting tables, is for the birds." And so, when you're desperate and you're a newlywed, you'll do pretty much anything. So I was painting apartments, fixing toilets and doing that kind of stuff up in the Rose Park area, just north of Salt Lake City. So back in that day, it's probably not the nicest part of town, but it is what it is. And then there was an opportunity, and I got a little jealous because I was out there in the cold, clearing the sidewalks and putting out ice melt and picking up dog doo-doo and stuff. But I noticed in the office, the leasing agent was talking on the phone, and the manager had a nice office, because this was like a 300-unit apartment complex. So I told my boss, I'm like, "Hey, I want to be a leasing agent, or I want to be a manager someday." And they're like, "Aren't you the maintenance guy?" I'm like, "Yeah, but I can learn. I'm a pretty smart guy. I can figure it out. I go to college." So they said, "We'll get back with you." So, but sure enough, a few months later, they called and said, "Hey, we have this small 60-unit apartment complex in West Jordan, Utah, out there, pretty far west. And we can't really afford a full-time manager or a full-time maintenance guy, but maybe you could do both because you know how to do maintenance. And there's a lot of vacancies." I'm like, "Okay." That was my introduction into management.
Wow.
And from that point, my career kind of grew. I went on to be a regional manager. I left that firm in Salt Lake City and went to work for Equity Residential out in the Pacific Northwest. In my portfolio as a regional manager there, got up to 10,000 units, and it's a big REIT. It's a big national real estate investment trust. I worked on the ownership side after that as an asset manager for an ownership. And then I was overseeing property management. And then at one point I owned my own property management company out here in Texas, where I live now. I'm in Austin, and eventually decided that, I was pretty successful as a property manager. And every time I did a good job, the owners of the apartment complex said, "Great, we're going to sell this apartment community and we're going to cash out. Glenn, you did a great job." Or, I got a pat on the back, and they got a big old fat check. And I remember thinking early on, it's like, man, I wish I was the owner, right? Mm-hmm. I mean, that was the dream. It's like, but how do you get to that point when you don't have any money and you're living paycheck to paycheck on a W-2, but you want to own the apartments, not be the guy that's just managing them for somebody else? So there's an introduction, right, to my...
Well, That's a great story, and hearing about, going from waiting tables to being the maintenance guy to then actually managing a 60 unit building. It's been a cool trajectory. And just to note, a lot of this story is told in your book. If you want to maybe just share your book with our listeners real quick, because I think, for those that are interested in hearing, maybe they don't feel like, maybe they're younger and they're really looking to grow in this industry, or maybe they feel like they haven't accomplished as much as they would like to at this stage in their life, and they're looking for some motivation about, going from point A to point Z. I think your book will be helpful to them. So maybe tell us a little bit about that.
Yeah, it's actually called Maintenance Man to Millionaire. It's available on Amazon. You could type in Maintenance Man to Millionaire or just my name, Glenn Gonzales. Either way, it'll pop up. Easy read. Probably takes, the average reader an hour and a half, maybe 2 hours to get through the book. First chapter, though, talks about the value of you. And then the second chapter talks about this big transition that you were just mentioning, right? Because everybody asks me the same question. It's like, how do you go from kind of small time to big time, and that's a great question. And there's so many variables to answer that question, but it is a journey. But in my mind, what really matters is you and your integrity and the value of you. And people tend to think other people are so much smarter or other people are so much talented. And there are lots of smart people in the world. There are very talented people, but that's not all of it. Part of it is you got to find the deal and believe in yourself, and then surround yourself with some really good people that are already experienced in the industry. And by doing that, you're going to avoid some mistakes that a lot of newbies make, right? And I just took all the years of experience that I had as a W-2 employee working for other people, packaged all that together. And so it didn't happen overnight, right? I was in the industry for 25 years, and then owned my own management company for a number of years before I even bought my first apartment complex. Buying my first apartment complex, I have to tell you, was a blow to my ego, but it ended very well. But I will tell you that raising money from investors on your very first deal, 9 out of the 10 said, call me when you've done this before, right? So all those 9 that told me, I'm like, well, do you know somebody that might? And they introduced me to other people. So it was really just a networking thing, but I ended up raising the money, and that story's in there. But when we sold it, it was like a 48 IRR to the investors. And then they went and bragged to all their friends, like, dude, you got another deal. And it just, I said, I do, right? And, banks were calling me that owned their buildings, and people were selling, and they knew me from property management days. And first thing I ask is, do you want to sell me your apartments? And I had a friend that was 70 years old. And I said, hey, when you're ready to retire, give me a call and I'll buy your company. And I didn't have money to buy a company, but, I planted that seed. It took him 10 years. And when he turned 80 years old, we'd stayed in touch over the years. And he just called me and said, you want to buy this apartment complex? He wanted me to buy his management company. But I told him, I don't want your management company. I want your apartments that you own. There are 8 of them up in the DFW area. So he's like, well, if you buy my management company, then I'll sell you my apartments along with it. I'm like, deal.
Interesting.
But David, I had to go raise $22 million from investors. I mean, talk about drinking from a fire hose, but I learned a lot about syndication. I learned about options out there with individual investors. I learned about all the crowdfunding platforms. I learned about private equity firms. I learned where the money is and how you can go gather it to put deals together. And I think that's what really launched my career. But it was a 10-year relationship from this guy that at 70, he was a mentor to some degree. And I wanted to be like him. And he's like, I'm never going to sell. And sure enough, it took him till he was 80 years old before he ever considered retiring. So anyway, that was a fun journey. That's also in the book, that whole story.
Well, that's a fantastic story. And what I want to do is maybe help our listeners understand a little bit about your business as it is today. And then I want to bridge the gap between sort of those early experiences and where you're at today. So if you can, just describe for us your business and what you guys focus on at this point in time.
Yeah, great question. So my day-to-day right now, I'm actively looking for new opportunities. For example, we just closed on a 120 unit apartment complex south of San Antonio. And that deal, we syndicated it, right? So we put it out there to investors in a 506B offering. And we have some people that invested 50,000, but some that invested 100,000, but we also had some that invested 1.5 million, right? So, and I think totally we had to raise about $5 million from investors. So we closed on that deal. It's doing very well. And so my day consists of trying to find opportunities just like that. Right now, there's all kinds of apartments and stuff for sale. And I think a lot of people get so anxious that they want to buy a deal that they convince themselves that I can raise the rent $400. When really they could probably realistically only raise it maybe $200 if they fix it up, right? But and we refer to that as the underwriting model and opportunity. And so people will underwrite, and we're very, very conservative. We're a conservative shop. So,
do you have a particular geographic focus and a property type or an asset type focus?
People have asked me that a lot, and it's easier to answer your question. No, but we focus more on stuff that's in our backyard. Like I live in Austin, Texas. I've owned a lot of stuff up in Dallas, San Antonio, here in Austin. And so we continue to look at deals all over for that. Typically, I've been buying value add stuff that was built in the 80s and 90s and fixing up and selling it. Well, because of the compressed cap rates and the demands and stuff, those prices on that product have rivaled basically what you can build a brand new one for.
Right.
So, you think about just the math. If you buy a deal that was built in the 80s and you have to renovate it and you're paying $200,000 a door for that community, and then you're getting, call it, $2,000 in rent for that unit, I can go build one for, $190,000 a unit.
Brand new. Not 20, 30 years old.
Yeah, I'm probably getting $1,900 in rent because it's just a little bit out of town, right? And so, but once it's built and occupied, it's worth $250,000, right? So you're creating your value add just in a different way. And the reason I share that with you and your listeners is because times change, right? That value add that worked, a few years ago was what everybody was doing. But, now that the price of lumber and everything else and the newer stuff is so darn expensive that you can create the same value, but that's not going to stay forever as well. Rents are going to get capped out. Prices will eventually come down. The interest rates today are climbing, which is going to affect cap rates and also returns. So it gets really complicated. I think I went on a little tangent there, David.
Well,
what do you do in my day-to-day, right? I mean,
yeah, no. I appreciate that. And actually, I want to get your insights on, the market today and where we're headed and sort of what you guys are going to be focused on moving forward. But as it relates to Obsidian Capital, how is your business structured today? What does it look like? Employees, individuals who are partners with you, what your role in that looks like, what others' roles look like? Maybe just break down sort of the organizational structure of your business today.
Yeah, we're at about 2,000 units now. We sold about 4,000 units. So we were up to 6,000 units, right? And I had 3 asset managers, an admin assistant, and a business partner. That was our team. And one guy that did acquisitions, right? We sold all that. We now are down to, one guy that does acquisitions and underwriting, transaction manager, and then Mike and I handle the asset management. He's my business partner, Mike Woodfield. He owns 50% of the company. So he's the COO and he handles kind of the operational side. And then the admin assistant that kind of helps with everything else. We third party all of our property management out. That's one that people ask, you do that in-house or do you? And here's why, we found an opportunity in all places, Hopkinsville, Kentucky, right? It was a 258 unit deal. It was mismanaged. It had low occupancy and the guy was dumping a ton of money in improvements. He had no rent roll, right? So we bought it from him. Couldn't get conventional financing because there was no financials about it, but it was a great deal. Well, the investors that put their money in were getting about a 13% cash on cash up until we refinanced and they pulled out almost 85% of their equity. Right now they've got very little money in it. And they're getting the same distributions. So, I mean, I don't know what their cash on cash is today, but it's way up there. So now we just travel there as an asset manager, and we found that deal through a co-sponsorship.
Mm-hmm.
Right? So when you ask about what do we do today, somebody brought us that deal because we weren't looking in Hopkinsville, Kentucky, but they're like, dude, this is a hot deal. You guys ought to take a look at it. The people that brought it to us had never purchased a deal that was 258 units. They're like, this is way outside our expertise. We're like 20 units or 30 units. And we're like, dude, well, let's just partner on it. So we were co-sponsors. We were supposed to raise half the money. And we ended up raising all the money, but we didn't split. We're still 50-50 partners with the co-sponsorship. So I'll look at deals that aren't even my own that I found if somebody else finds it. And they're like, this is a good deal. You should take a look at it because we have a great track record. We can co-sponsor. And that's a great introduction to people who want to get into the business as an active sponsor, but have never done it before. Find a deal, partner with somebody that knows how to do it. Right.
And so would you say that the majority of your more recent deals have come through a co-sponsor sourcing the initial deal and bringing it to you? Or are you still actively out there trying to source your own deals as well?
Yeah, I would say out of the last 10 transactions that we've closed, I would say that 3 or 4 of them were brought to us through a co-sponsorship. So we're still actively looking. And here's
still
why.
The majority is you are out there sourcing your own deals.
Yeah. And for your listeners, here's why is, when we find a deal and we have investors in there, they're going to call us and say, how is this deal performing? If I have a co-sponsor and they've got input or influence, or opinions, we are sensitive to our co-sponsor decision-making process.
Sure.
They're not always our own, right? But yet we are fully responsible to our investors and their money, right? So it's kind of an odd relationship, and it's been successful. But if I had to choose to answer to my investors 100%, I'd rather put them in a deal that we own and control by ourselves.
Yeah, makes sense.
The reason we co-sponsor is because there's not a lot of deals out there to be had. They're hard to find.
Right.
They're hard to find, that make sense. There are a lot of deals, but they don't all make sense.
So that's a great transition to sort of talk about where we're at in the market today. One of our goals with the podcast is not to do interviews too far out so that they can be timely in what we're discussing. Right now, interest rates have skyrocketed. Last I heard, there was, did they push into, 6%? I think they did on yesterday.
Yep.
So the first time they've gone to 6% in, I don't know, a very long time. And so what that's done is it's put a lot of pressure. I think that there's still a disconnect between owners and what they want for their asset and cap rates versus the debt market and that relationship between a new owner being able to acquire the deal and still produce a reasonable return on the investment when interest rates are as high as they are. And so it's caused this dynamic where maybe the owners are still expecting to get this price, and more buyers are a little bit reticent to actually pay that price because they know that the cost of their debt is a lot higher than it was in the past. So I'm curious to get your thoughts on where we're at in the market and what you're doing to navigate this sort of uncertainty that we're in.
Yeah. David, you nailed it on the head. What you just said there about where we are in the market and that disconnect between the owners and, new debt coming in. If you think about it, if an owner thinks that his property is currently worth a 4 or 4.5 cap going in, and the debt market is quoting a 6 or 6.25 interest rate, there's
that's a problem.
There's the problem, right? And for your listeners, you just got to translate that in, right? You're making a mortgage payment that is eating up most of the cash flow on a deal that's leveraged, and you've overpaid for a property if you bought it at a low cap. So, your investors aren't going to get much money. The only way to really mitigate around that is to be patient and to put your purchase price and your offer to buy a deal at a realistic going in cap rate. And you have to be patient because, David, you mentioned it, right? The owners still think their property is worth all this because what they paid for it and what they put in there. but the economy is what's going to reset that expectation naturally. So you're going to see deals on the market a little longer. Now, here's a big shift is if people were buying deals 4 or 5 years ago and they got a Fannie Mae loan, right? That interest rate that's locked in is, 3 or 4%. So people did not want to assume an existing mortgage because they can go in and they could leverage up and get a new loan. Well, now you can't leverage up. I mean, you're constrained by the debt coverage ratio with higher interest rates. So the lenders aren't going to let you leverage up. You're going to get a 65 or a 70% loan to cost.
Right.
Well, if you go assume one of those loans and you bring enough investor money, then you restructure it in today's environment and you pay the right price, you could probably get a assumable Fannie Mae low interest rate, and then you just wait it out. Right. So,
interesting.
Those guys that are selling right now have a prepayment penalty on most of those low interest rates. Right. So they don't want to eat it. So if you can find deals that are structured well enough where they either still have some interest only remaining, but if they burn through it, but it's a low interest rate, rents are still on the rise, right? So so many different ways we'd have to talk because every deal is a little different.
Yeah. So are you seeing with the offers that you're putting out, are you seeing that there's still buyers that are banking on either their ability to add enough value to combat the higher interest rates, or that buyers that just have their blinders on as to what's going on in the market that are still willing to pay? I mean, because there's still deals being done. It's dropped dramatically, but there's still deals being done. And I talk with a lot of investors that are saying, hey, we lost out on this deal because we offered what is realistic for where the debt market is today. And someone was willing to pay a higher price that they simply couldn't get to. So what's happening with these deals where people are actually paying the cap rates that were around in the last, 2, 3, 4 years?
Yeah. So, David, this is my opinion. A little bit based on fact and some of the reports that I've read, but you said deals are still being had, right? People are still buying apartments, and how are they making money on it? The investors that are coming in on those deals oftentimes are willing to get a 1%, 2%, or 3% return on their money. Now, why are they doing that? Right? If you look at Bitcoin, just took a huge crash. The stocks are down, and returns in the marketplace, in the financial marketplace, are not getting good returns. Matter of fact, they're projected to go down. So we have inflation and hyperinflation and interest rates, and because our economy is so volatile right now, people are pulling money out of that, and they're going to set it in real estate, and they know that it's going to reset, but they know that it's probably safer there than it is there. So you see this big shift in capital going into real estate, and those guys will be satisfied with a very low interest rate or low cash
return.
On cash. With low return. And that type of buyer is more of like an institutional buyer, right? Like a family office or an institutional investor that is putting a big chunk of money. They can sit on it and just let it ride. They feel like multifamily is a safe haven for capital during uncertain times, so they just plunk it down, let it ride. Whatever it is, they know it's going to be at least safe and secure, and most likely give them some return that's probably better than some of these other more volatile investments. But what it does is it makes it difficult for a syndicator who's taking retail investors or your typical W-2, right? That are placing $50,000 to $100,000 and have been expecting to get 7 to 9% cash on cash returns and 15 to 17%. So that it puts guys like you that are actually raising equity from this mom and pop investor to actually get them to swallow that type of return profile. Low return. Yeah. And that's why we're losing out on deals. I lose out on, for every 10 LOIs that I put out there, I'll make best and final on probably 3 or 4 of them. And I'll probably get to the number 2 in line and I'll come back because I just refuse to go into the 2 or 3% cash on cash with my group of investors. So like I said earlier in the podcast, it's getting harder and harder to find deals.
Mm-hmm.
Right? And what I think is going to happen is the ones that bought a year ago may find themselves more in trouble in the next 2 years. There'll be more deals that are reset naturally by the market that people have to get out of. And there may be some opportunities there. Right now, it's a patience game.
Yeah.
If you can find deals where people need to unload their apartment off market, and everybody says that, right? Those are the deals to have. Those are the investors that are listening that want to put money in. They should be out there looking for deals too. They might not want to be an active syndicator. They just might want to be a passive investor. But if they find the deal and bring it to a syndicator, that's worth money, right?
Yeah, absolutely.
Yeah.
Well, I want to sort of bridge the gap between where your business is at today. Right now, you guys have sold off a bunch of units. You got as high as 6,000 units. You sold off roughly 4,000 is my understanding. Right. And then, so you guys are currently have about 2,000 units under management, mainly based in generally the Texas market, but it sounds like you have a few in other markets as well. Is that correct?
That's correct. Yep. Okay. That's exactly right. And we're building 3 ground up deals. So really those take a little more time, but we're building 156 unit north of Austin, an 84. And then there's a small community called Taylor, Texas, that's on everybody's radar because Samsung just announced a big chip manufacturing plant here in Texas. And it's $1 billion plant, not too far from where Tesla built their plant. So, so we're developers now.
And what type of product is that? Is that like A-class stuff? I mean, obviously it's brand new development, but who are you targeting as the potential tenant?
Even though it's brand new construction, I'm going to call it a B property, right? Because some of the smaller ones, they don't have a swimming pool or a big leasing office or a weight room that the Class A's have, but they're still brand new with garages and big patios. So that we're catering more towards the family, but you can rent that same apartment. It's probably $300 less than the Class A, right? Because it doesn't have all those amenities. There's so many people building that super nice Class A stuff that there's nobody really focusing on the brand new A- or B+. So we're trying to capitalize on that. Yeah. And then the other one is a for sale product. It's condominiums that we're going to build for sale townhouses. Just because we came across the opportunity. It was dirt. It was already zoned. We bought it, closed on it, and we're pulling the permits right now. And we're getting a construction loan. Has
the interest rate hike had an impact on the development process for you in those deals?
Not yet, because that one's going to be a for sale product, and our interest rate that we got quoted was 6 months ago, and we're still there. But I think what could affect us is the resale, right? If the interest rate for the consumer, if they're now paying 6 or 6.25% in interest rate on their home out in Taylor, Texas, that may prevent us from really maximize our sales price. So that could, but it's not the lumber anymore or the others. We've already adjusted all of our construction costs to accommodate the higher cost to construct, but that variable on the exits might, dilute our returns a little.
Yeah. Well, I went off on a tangent there, but I want to bridge the gap between sort of your early story and that first, 60 unit apartment complex that you managed took on as a leasing agent and took over. And then use 120 unit in San Antonio. Like, talk to us about this journey that you've been on in getting to ultimately acquiring, roughly 6,000 units from where you started and got your feet wet early on. What has that journey been like?
So that one has been a very exciting journey, right? Because I've had partners that have started with me and then left and then reorganized. But I remember there was an opportunity that we had to buy a 650 unit deal. It was one deal. It was up in Dallas, Texas. And in order to get the financing, because I was still a little early in my career, I didn't have the liquidity that was required by Fannie Mae, nor did I have the net worth or liquidity, either one, to sign on that loan. So we ended up partnering with the family office that was looking for deals, and they put up the money, but they also signed on the loan alongside us as the sponsor. So because they did that, I had to really take less of the piece of the pie. But that smaller pie on a 650 unit deal is still a lot of cheese,
right?
Or apple, if you're eating pie. In this case, a lot of queso. Yeah. So, but the journey has been one of those where you can't be afraid to make a decision or jump into this. So I think what really, really motivated me, and this is in there too, is when I went to buy my apartment complex here in Texas, it was because a bank came to me and said, "Hey, will you manage this?" And I told the bank that they needed $1 million to renovate to get it stabilized. And the bank said, "The reason we're hiring you is because we're going to foreclose on it. We don't want to put any more money in this deal." So I said, "Well, I know I'm going to manage it for you as a bank, but why don't I put up the $1 million?"
And just to give us some context, when was this?
This was back in 2014.
Wow. Okay.
14.
Interesting.
Yeah. And so they were going to foreclose. So if you remember post 2008, 2009, right, when there was that crash, and then this is just after that time period, right? So those guys weren't making money. So I told the bank I'd put up $1 million, and they asked me, they're like, "Do you have $1 million to put up?" I'm like, "No, I don't have $1 million. I run a property management company," and they're like,
right.
"Well," I said, "but I know people that do," right? And that's where I was telling you that 9 out of 10 people told me no, but we structured it. The bank did foreclose, and they carried a note back for me. So back in those days, I'm like, instead of applying, if you're a lender and you're going to foreclose, you get the note back. Why don't I be your borrower? But if I put up $1 million and I put it in your checking account, what do you got to lose? So this is a conversation that you have with a lender that most people don't know that you can have that kind of conversation with a lender.
And do you foresee that there's going to be more of that happening in the near future with the way the market is shifting? Do you foresee more restructuring, foreclosures, that type of thing going on with larger commercial apartment buildings?
I don't, and here's why: is I think that there's going to be a lot of property owners that are going to struggle, and they're going to become on a watch list, and they're going to be in trouble with the lender. But I think the lenders got smart a little while ago, the last time there was this big crash, and they have not over leveraged, and they require a little more liquidity. I think what's going to be is an opportunity to recapitalize a deal, right? So I don't know that it'll actually get foreclosed on. Maybe it will, maybe it won't. I mean, during COVID, a lot of apartment complexes got foreclosed on, right? There just wasn't rent and occupancy, and it happened to the best of us. So it does happen. But I think that there's going to be investors that will come in, step in a deal before it gets foreclosed on, and get recapitalized or restructured or rearranged with the bank and new fresh capital that'll make the bank feel better. But I don't see this big, massive foreclosures coming across because there's still a demand for housing right now.
Absolutely. Sorry, I got you off track there. You started to talk about how you structured this first deal.
Oh, yeah.
And then I got you off track. So let's pick back up on that.
Yeah. So that deal was a syndicated deal. We went to investors 9 out of 10. But we brought all the money in from investors, and I think we had 6 or 7 of them that all put in various amounts, anywhere as little as 50. And I think the most person put in 250, but we at that time only had to raise $1 million.
Right.
And we were only in that deal 1 year. We sold it 1 year later. So because somebody stepped in and said, "I want to buy the whole apartment complex from you." And we took it. Looking back on it, I probably should have held it a little longer, right? Because things just went crazy in 16, 17, and 18.
Yeah.
14,
that's true.
15, right? So
when was your next deal? So that was your first one that you actually, raised money for, got some outside investors in and pulled the trigger on. When was your next deal? Was there a gap between that one and others, or was it sort of bang, bang? You started to get involved in buying more and more?
Well, I feel really blessed and quite fortunate. My next little deal was a deal that I used to manage for a bank. I was a property manager, and they called and says, "Hey, Glenn, after you left, the deal you were managing has gone downhill. We're looking at, offloading this or putting it in another management company." And I said, "Don't do that. Just sell it to me." They're like, "Well, that's why we're calling. Do you want to buy it?" And I'm like, "Sure." So they called me, right? And that was a small, what was that? 52 unit deal, 60 unit deal. And that was up in Killeen, Texas. And David, right around the corner was this boarded up, ugly, apartment complex that had like 30 units in it, where all the homeless people had broken in. And it was really bad. And I just remember telling my partner, I wish whoever owns that would just fix it up, because it's an eyesore and it's affecting me.
Right.
Well, that's what I do now, right? It dawned on me, like I buy apartment complexes. So we figured out, we got online, you did the research, found out who owned it, was bank owned, foreclosed on,
Mm.
3 years earlier. And we put in an offer. Get this, it was 32 units. I offered them $250,000 cash and they took it.
Wow.
I bought it. Yeah. And then but it needed, call it $700,000 in renovations. Right. So,
Mm-hmm.
but during our due diligence, I went back to the bank. I'm like, did you know that you have hail damage all over this roof? Like, we had no idea. We haven't been out there in years. We don't care.
Yeah.
So we just put in a claim and see if they'll pay it. Like, sure. I mean, it wasn't contingent or anything on me buying it or not, but we bought it. And 3 months later, they said, I got a check in the mail for like 40 grand. Like, hey, we got this from our insurance company. And since you bought it, we thought, you would be entitled to it. It's for your roof. I'm like, that was really nice of you guys. That was like a golden nugget.
That's great.
But you don't get it if you don't ask, right?
Yeah.
So that was that 2 deals. And then again, I bought a deal in San Antonio where a previous owner that I just knew from property management was in trouble and says, can you come manage this? And I'm like, I don't manage anymore, but I'll buy it from you. Mm. Right. And then there was that gentleman that I told you that had 8 apartment complexes. His name's Ed. That happened. We worked that out. So in a short amount of time, I'd probably bought 10, 12 apartment complexes. And just through social media, we put that out there. We were putting press releases and was saying we're doing this. Now, all of a sudden, my phone is ringing off the hook, David, because brokers are now like, hey, I noticed you bought these 3 apartment complexes.
Right.
Who are you? How long have you been in the industry? Great story. Wow, that's awesome. I got another deal for you. And then I have these brokers bringing me deals, and they're bringing me good deals too. So, I mean, one broker brought me 3 deals, and I bought through the one broker, and just through relationship. And I have a whole chapter in the book that talks about just maximizing relationships, whether it's with another investor. Like, you have some listeners that probably have friends that have 4 or 5 people that maybe want to go buy one together, but they have some money, but they don't have a deal. Well, then you got other people out there that come across deals all the time. They have no money. It's how do you network with all of those and actually put it together? And you can only do that through relationships. So.
Well, that is a great note to sort of wind down on. Before I let you go here, maybe talk to us briefly about the importance of relationships in the trajectory of your business.
Yeah.
You mentioned it lightly, but can you think of any specific relationships that have had a key impact on your ability to build and scale your business over the years?
Yeah. I alluded to that one about, Ed selling me 10 deals when he turned 80 years old and stuff. But I will share with you another experience. I was at this point selling about, I think it's a 160 unit deal up in Dallas. And about 4 or 5 days before closing, this had a chiller on it, like one of those big chillers that, provide the cooling and stuff. And it just is so old. It was probably installed in the 60s or 70s. It broke and the broker panicked. And he called me. He's like, dude, what are you going to do? We could have put a Band-Aid on it, just kind of did a repair, but I know it would have broke, right? Because we were getting these opinions from people. I went to my business partner and I said, I think we should just buy the guy a new chiller. He's paying a pretty good amount of money for our apartment. We're going to do well. Our investors are going to get chunk of money back. And my business partner at that time, he's like, no, we don't need to do that. He's got non-refundable earnest money. He's forced to close. He's passed his due diligence. I'm like, yeah, but it just doesn't feel right to me. I mean, what if I was the guy buying that deal? And so I got in an argument with that business partner, and he's no longer my business partner, but I said, look, we're going to do the right thing here. So I called the broker back, like, we're going to buy the guy a brand new chiller. And the broker's like, are you serious? And I'm like, yeah. And he's like, why would you do that? I'm like, what if I come across this guy some other time and I'm buying his apartment complex? He's either going to want to get back at me, or he's not going to sell me the deal, or he's going to tell all the other guys what a rotten guy I am. So he's like, dude, that's integrity. This whole story, by the way, is conveyed in the afterword of my book,
really?
Right? It's written by that broker. So, it's a more accurate through his perspective. But fast forward here a little bit, I'm sitting at a conference, a networking conference in California. And we went around the room because there was only about 30 people in the room. And this guy was introduced, we're all introducing ourselves. But this guy stood up. He's like, I don't want to introduce myself. He's like, but I want to introduce that guy sitting right over there. And he pointed at me. And I'm like, oh, crap. What did I do? Who is this guy? Because I don't know who he is. Right. He's like, I was buying this apartment complex from him. And 4 days before closing, the chiller broke. And that guy bought me a new chiller. And he could have walked away and did nothing, but he did the right thing. And so having somebody else convey to a room full of people about your reputation in the industry will pay huge dividends on a go-forward basis, probably, and follow you your whole career. So don't let greed and all that other stuff get in the way of the big picture of stuff. And if you do the right thing, sometimes you might make less money, but life's not about money. It's about people and relationships. And when you put your focus there, the money will always follow.
Love it. That's a great note to end on. Before I let you go, what's the best way for our listeners to connect with you and learn more about what you have going on?
Just email me. I love chatting with people. My email, can I just put it out here?
Yeah, absolutely.
Glenn with 2 N's at obsidiancapitalco.com. So obsidiancapitalco.com.
Perfect. And we'll have
right. So
yeah, we'll have that in the show notes. So if you're listening and the conversation that we've had with Glenn today has resonated with you and you want to connect with him, go down in the show notes right now, click on that email and link up with Glenn and his team. Glenn, it's been a privilege to have you on the show. I loved hearing your story about how you started, waiting tables and then had an opportunity to go and manage a small apartment building and then ultimately progressing through those stages of becoming the maintenance man and managing a bigger building, and then having the opportunity to buy a building and then scaling from there. It's a cool story. Again, your book, before I let you go, what's the title of your book?
Maintenance Man to Millionaire.
Perfect.
That's it. Okay. Thank you, Glenn. This was a lot of fun. Yeah, I can't thank you enough for letting me be on your show because this was fun for me. You're a good man.
Well, thanks, Glenn. We'll be in touch.
Okay, thank you.